Good day, everyone, or good evening, depending on where in the world you are, like myself. We've got a market that is exuding some volatility, some choppiness, which is pretty unpredictable here. The one thing we know is that the central banks are printing money, and so that puts a floor under the markets of some level, even if it's a deep floor. There's a floor nonetheless. We've seen that pattern for many months now where the markets will have a heavy sell-off because of global economic concerns, only to have central bank presidents step in and soothe the markets by jacking up their quantitative easing programs. And that's just been a broken record. It just keeps repeating. I think all of these central banks are under intense mandates to continue to print money. So I think that is going to be part of, or a big part of what controls the markets. Certainly that's been the case since 2009. And it's just a matter of these politicians making sure that the markets don't undo what they've done. That is since 2009, had this big bull market, and then signs of exhaustion appeared in 2015, making that one of the toughest years to trade or to outpace the markets on record. And this year, of course, has been no picnic because of the enhanced volatility, and of course the market wants to fool the majority at the majority of the time, and this bounce has certainly fooled, I think, the majority of people, because it's gone a lot further than many people thought. But nevertheless, the power of central banks is quite pronounced, as we all know. And the market's going to be, wiggling back and forth here. It did a lot of that last year. There were very few clean uptrends. And in this QE environment over the last, many years, that's the problem with a lot of these uptrends. When you look at a monthly chart, it looks like, wow, there's a lot of money that could have been easily made. But certainly if you were to just buy and hold, this is the first kind of market where buy and hold was outperforming all the other types of investment strategies, simply because trying to negotiate the markets in a trend-following way, or like the market wizards have done for, say, 30 years in their illustrious careers, which is why they're market wizards, running, in many cases, billions of dollars, if not hundreds of millions, and outperforming markets. All these guys have been underperforming since 2009. And it's the first time in their careers that this has happened as an aggregate group, and also on an individual basis. And I think we all know that some of these big names just dropped out. They just retired. They said this market has become too unwieldy and unpredictable for their style of trade, and so they just ended up quitting. But of course, as we all know, the only thing that doesn't change is change, and with all these changes to the markets, that creates a lot of opportunity, because there's always a new way to skin a cat, and certainly new ideas will always evolve, and that's why there are no such things as black boxes that just don't need to be continuously self-evolving and fine-tuning themselves as the markets evolve. And this is an evolving market. Certainly new challenges are being thrown at us every year, and that creates the incentive to come up with new solutions to the existing environment. And I think a big part of being able to maintain a certain level of profitability in these environments is to not get wedded to any particular approach, because we've seen, for instance, many things that worked prior to QE stopped working during QE, and then as the flavor of QE intensified, then certain things there were additional things that had to be thrown out. 2013 was a very difficult year because it was a year of very few corrections, but the uptrend was also very questionable and lackluster. So there were no real strong uptrends like in a healthy bull market that we would be accustomed to. This year, as I wrote in, I think it was on the first or second day of the trading year this year, that we would be seeing most likely enhanced volatility, and so far that seems to be the case, and that's a good thing, because with volatility come additional pockets to profit, as opposed to the 70s, which I remember O'Neill used to say there's some years in there that were so difficult because the markets just weren't doing anything. And you can go back and you can look at those charts, I think in the mid 70s, and you can see, sure enough, the NASDAQ was just kind of in a very tight basing pattern, but not really moving around much. Yeah, he said those are very lean times, and I can imagine. But this is a totally different environment that we're in, and I think volatility can certainly work in your favor. It certainly has worked in the favor of taking profits where you have them, and keeping your stops tight. It worked very well in 2014. 2015 was a different can of worms altogether. So it worked, but didn't work nearly as well. And then this year is a whole new set of challenges. But that's fine. We just keep it keeps us on our toes, and not only that, it really refines our investment techniques and also our investment psychology. Because if there's any cobwebs around up there, then they need to get cleaned out. And this is the kind of market environment that cleans out the cobwebs, because it amplifies any weaknesses you might have as a trader. So keeping those trading journals, I think, is very essential, especially in this kind of environment. We have leading stocks that a few of them have hit actionable buy points. We've been emailing those out, but still, there's not a real convincing thrust of a ton of names coming through in convincing fashion. So in our write-ups, we're always suggesting that people go ahead and buy as close to their respective moving averages as you can, so that your risk in getting on a position is maybe just a couple percent. Because you get days like today that the market's just kind of going. The last few days, the market has a big down day, then a big up day, and then now a big down day. And you can definitely utilize this volatility to your advantage by getting a really clean entry point that's very close to that moving average. And so, if you do it in a very optimal way, you can really limit your risk to less than 2%. And of course, that's what the VIX volatility model is. I think that's where it really thrives, is these fail-safes that adjust to market conditions. But generally speaking, across the many cycles run in the testing that it's been through, these fail-safes tend to be very tight and very clean. And the current market environment, most of you probably noticed that the fail-safes are contained within typically 1.5% or less. And if the trade goes enough in our favor, then the fail-safe moves up to usually a break even point. And then, of course, if it keeps going, then we've advised that you can start taking profits on some of these signals. The profit-taking strategy has been incorporated in the model on the buy signals, because you get these spikes, downward spikes in the market, where you can be up 15% or more in a day or two. And so that's happened a number of times, and it's also happened that the profits vanish if you don't take them. So having a firmer rule in place, I think, is a good thing, because it's very, very simple and very easy for a trader to see the profits quickly and then get greedy, thinking that they're going to even go up further from there, and then they don't. In fact, they can reverse back down pretty quickly, just as fast as they accumulated. So I think having a rule in there is a good thing, especially since that rule, I was quite astonished to see how much it improves the risk, and how it didn't rather improves the reward to the profitability to the model, but did not in any way increase the risk, which is very rare situation in these strategies, or in any kind of strategy where you get that kind of situation that just falls right into your lap with regards to the model. So, at any rate, I think this market is also still, as I was mentioning, there's still some correlation with oil. The price of oil is coming off today a couple percent. If you look at the overall pattern, it seems like we had some kind of major bottom in there. And the question is, the argument here is that inventories are likely to drop off, which is going to further bolster the price of oil. So, in other words, the price of oil, it hit 40 a barrel, and now it's back down to around, I guess, 30, 36, 37. But the uptrend, some people are calling for a price range between 40 and 50 or 60 in the ensuing months, if this inventory argument holds. So that remains to be seen, but certainly that will probably help as a tailwind to these major markets, helping them move a bit higher. And of course, the QE phenomenon will also act as a tailwind. And with that, I will turn it over to Gil.
Okay. So I think the only thing that changes is change, which is always changing, especially in this market. What I find interesting about today is I'll give you guys this is kind of an overview of what I was looking at this morning when I got up. I came in long Facebook and Umbrella. And you can see Umbrella was holding tight after this gap up. Facebook recovered off of the 20-day line when selling volume dried up 3 days ago. And it's moved back to the 10-day line. I should point out that I have flipped and gone short on the 620. So that position has changed, but that's what I came in long. And then I came in short, Elke, or Alaska Airlines as I call it, which I'm looking at as a possible, let's look at the weekly chart here. You get this deep, this is about a 30% deep cut, but it's very V-shaped, so it's not rounded, it's not coherent, it's just kind of straight down for 7-8 weeks and then straight back up for 7-8 weeks. And now they announced they're buying out, what's the name, who are they buying out? I forget, Virgin America, that's right. And so they gap down and they rally back up. So now when I'm looking at a pod, if you read the new book on short selling, one of your first indications that you might be having some trouble is a breakdown through the 20-day line. And so you have this on a big volume gap down. So it rallies up in here, and I'll test out a short position, and that works. It comes in a little bit. Now we're under the 20-day. So I come in short that. It's down $1 right now, so that's working. The other one I was short was GoDaddy, which I shorted yesterday. It was coming up into these lows along this base, and they came out with a 16.5 million share secondary offering, okay, and the stock was jacking at like 31.70. I think it pulled in a little bit to like 31.30, and then it's turned back around. It's at 32.24 and moving higher. But they dump a bunch of supply into the market on this stock, yet it moves higher, which seems kind of bizarre. So I'm not sure how they're manipulating that, but it didn't do what I expected. So what I find interesting is the market's down this morning. Futures were down. Facebook rallies. Umbrella jacks $1.80. Okay, you can see it here, and now it's up whopping 30 cents. So it's like this move comes and then it goes, and things don't really act the way you expect them to, and so it's just kind of a nonsensical market. So it makes it difficult. But net everything sort of offsets everything else, and it's kind of a non-day for me with the index is down, although I'm looking here at potentially more of a sell-off. I think you're in a position where you can roll over, and yeah, there's been a floor under the market here, but there was no floor here. So I don't really think you can apply this general idea that, though the market has a floor under it, yeah, it has a floor under it, but is it 3 stories down, 5 stories down? It's somewhere down there. So you can't really assume that every pullback is just a a viable pullback. I think you have to play it very tight by looking at buying stocks as close to a moving average as possible. So, Dr. K was talking about that. So you see yesterday and the day before on Amazon, for example, comes into the 10-day line, and it pops higher, but today it's rolling back into the 10-day line. And that's all typical because you're basically just chopping sideways, but are you really in a pattern where you're going to see significant upside? Is it going to turn around and go higher, or is this just building a big head and shoulders formation? Tough to say. But I think a lot of these patterns are kind of goofy, and things can go one way one day and then back the other way the next day. So yeah, I'm watching GoDaddy's just continuing higher, which I think is strange. Market's down 150 on the Dow right now. Nasdaq's down 57. Volume is up. It's looking pretty weak right now. We'll see how this carries out. But you could carry down. I wouldn't be surprised if you carry down to these lows. That's a possibility. But you are in a position where you can pull back more. I don't know necessarily. If you look at the, I'm looking at the Russell there. Let's look at the Nasdaq. Yeah, you're right at the 200-day line on the Nasdaq, so you might want to watch for some sort of a bust here that sends this thing back down to the downside. It's been heading, it's trending higher ever since the early part of February, and so you're kind of getting long in the tooth. So my inclination to be aggressive on the long side without at least being partially hedged with a short position or two at any time is not that high. I want to be somewhat hedged up here, and there are some setups that show up. So, I'll hit some of those. I think the Elky was a good one. It's working so far, down 92 cents right now. But you are in a position where you could see a pullback. Now look at the broader market on the NYSE Composite Index. It's running into resistance at around the 200-day line. So I would keep an eye on this, because so far what we know is that it hasn't been able to get above the 200-day line as the Nasdaq Composite and the S&P have been able to. And this is the broader market, so you definitely have to keep an eye on this, because if this starts to falter and break, then you could start to see things come off pretty well. But you're pretty far up off of the lows. So either you're going to chop sideways and maybe set up again as we move through earnings season, or you could roll over. And I think you have to keep an eye on what these things are doing. And I think you're in a position where the market could tip either way. So again, if you're going to go long, then the strategy is simple. You pick what you like. So examples, Facebook. So Facebook looks good. As it pulls in a 20-day, it looks ugly here, and a lot of times they do look scary at the point where you need to be looking at picking up some shares, and then they'll turn and go higher. The only problem, what I don't like here is, number one, you have this sort of wedging rally. There isn't any big volume, and once you got up to the highs here, it acts more like a double bottom, or I'm sorry, a double top. When it rolls off the peak and you get hit with heavy volume, takes you down to the 20-day. Now the selling volume dissipates, and now you move higher. The only problem is you're not seeing any heavy buying volume in here. There's no real big support up the 20 days. So I'm actually wondering whether this will bust the 20-day line and head for the 50-day line, in which case it's a short. And I will use the 620 chart if I can find it. It's somewhere on here. My jungle of charts here. So you can see it becomes a short right in here. You can actually use the MACD cross up here. So, and so I'll hit it on the short side. If I'm long, I just flip out of the long, go short. So yeah, I know that sounds crazy, but that's kind of how I operate in this market. I can be long something early in the day and then short it later in the day. So somebody points out that the NYSE Composite, the yearly chart, yeah, it shows it is a long-term downtrend. I've actually talked about this before. Because if you look at this, you can see that you're in this downtrend channel, okay? So now you're now at the highs of the channel, you could say, and you're in a vulnerable position. And so, in my view, you're in a position where you could roll over. So if you're going to try and buy things here, you have to be looking to buy them on weakness and at a point, again, where you have a logical area of support, like Facebook coming into the 20-day. And then if it doesn't work, you can blow out of it quickly rather than trying to buy into the pocket pivot breakout here on strength. And that's the only way to operate. But at the same time, if you buy them excuse me, if you buy them at a moving average or an area of support, that has to act or serve, and you have to abide by it as a tight stop, okay? And that's the only way really to play this market. Okay, you know what? I think you guys all should just like short the crap out of GoDaddy. I don't really understand why this thing's up here. They're losing money. I like the breakout, but now it's failing, and I look at it now as a potential late-stage failed base. So I'd be watching how this thing acts today. If it reverses back to the 20-day, it could become a short. But I got to think something's being manipulated today. But just let it play out and use your 620. Let's see what it looks like here. Yeah, see, it's just continuing to charge higher. But notice the volume's kind of petering out. So I got to think at some point in here you're going to roll over. So keep an eye on this one. This could be interesting. I mean, I'll play a technical breakout, or actually on GoDaddy, I thought this was viable along the 20-day line while it was holding tight, because if you saw this on the weekly chart here, it had tight closes. So and then it pops out, and you have to wonder whether that breakout was manipulated. And Morgan Stanley, I think, who is doing the secondary for GoDaddy, they're shorting it, and that's what they'll do. The underwriters will short the stock on a move like that because they want to be short to support it and buy it when the secondary comes out. And it looks like that's what they're doing. In any case, getting back to this, you can see clearly we're in a downtrend channel, okay? And it's if you think about it, we're still in a bear market, okay? We're still in an overall downtrend in the indexes. There is no bull market. There is no wonderful can slim market where you're going to buy leading stocks and they're going to double and triple, because there is no secular flow of money into the market. So you get this volatile choppiness that's highly rotational. They go into the dogs and drive them up off the lows after hammering them. So you've had Biotechs recently, but I think this is a sketchy group. I know some people want to get excited about them here, but they're basically still on their lows. So they never have rallied, even as the market has come way up off the February lows. I mean, here's February, okay, and this is where Biogen is gone. Look at Gilead, it's probably a little bit better. It's come up a little bit, but not as powerfully, and very slow, off the lows. And then you have Celgene, which is barely up off the lows. You look at these charts, these look ugly. So, yeah, if you catch this as a trade, that's nice. But is this a big trending thing that's going to start going higher? I don't know. It doesn't look like it to me. And these things can get hammered just as quickly as they can rally. So I think it's mostly a trader's market. And what I find myself doing over and over and over again, and I'm able to inch higher slowly. And so far I'm working on my 4th year in a row where I've been up. Of course, it's still early and I could still screw it up badly. But I'm working on my 4th straight up year, which I've never had more than 2 straight up years, and so 4 I think is pretty good. But this is the only way I can do it. I'm not achieving it by what I did in the 90s, which is buy stocks breaking out and then watching them just jack to the upside and double and triple while you just sit there and play dumb watching it go higher. If you do that in these markets, you can see your gains disappear pretty quickly. So you look at, say, Silicon Motion. I mean, this is classic. You get a breakout here. It pulls in. Okay, so you get the pocket pivot. We did put it on, right, Dr. K? I think we did put this one on right here as a buy. But notice how you get this big volume jack. You see this? And that was 7 days ago, trading days ago. And you see this jack. So in the old days, that would be a sign of power. And so Bill O'Neill generally would be adding on those kinds of moves. But what happens? You're up 17.5% at this point from the breakout, and you jack to the downside after this powerful move. It's like, what was that? Does it just create a situation where the buyers all rush into the stock and then there's nobody left to buy and it just descends to the downside on, as volume dries up? You see the first day you come down, you hold roughly mid-range, but then the volume dries up over the next 3 days and the stock just slides lower. And that's a little perplexing, but it does find support around the 20-day. But this is a little easier said than done in terms of trying to buy this move, because what the thing is doing is busting the 20-day moving average during the day, and it moves down to a low of about 53. So it's pushing through it. But if you're using your 620 chart, you might be able to pick off a buy point on an intraday basis. So for example, let's go yesterday. Where's yesterday? This is yesterday, is that right? No, I'm sorry, I'm way off. Yesterday was what, Dr. K? 4.6, right? Yeah, 4.6, so here we go. So here's, it busts down and right at the opening and hits the lows and then turns around. So if you're watching this in the morning, you see this break and then you see it turn and then you see the 620 cross. You go along there, and if it breaks back down, you can exit, stage right, okay? So that's one way to handle these when you see that sort of a break. You know, Max Linear, I want to call it Max L. Whatever happened to Max L? That was a public stock at one time, the tape maker, way back when people used cassette tapes. Anybody remember that? You date yourself, I think. You really date yourself if you remember, what were they, beta tapes or something like that? I forget. I remember a friend of mine had those, and they were huge cartridges, and he had them piled up in his back seat of his car because they were so big. If you wanted to have a big collection of them in your car, you had to pretty much give them their own seat. But this one, you know, shakes out, and again, this is a situation where you come all the way back to the top of this structure, and you shake out, and you could use the 620 chart to come into this on this particular day. But you know, when you have gains, you have to take them, and then you see this crazy action, and then they just chop them up. Look at, remember we were talking about this last week? I thought this was a short around here. It gave me a little fake out here, but then you get a shortable gap down move if you're awake and alert to this when it happens, and you're willing to take the risk because it gaps just below the 26 level, which is the prior breakout point. So in my mind, I would be using that as my upside stop. The high is 25.92, so they're roughly the same in terms of price level, more or less. 26 to breakout and 25.92, and so you just continue lower. You bust the 50-day. So now any rallies up into the 50-day at 24.94, I'd be looking as a short. Look at First Solar. Here's another one. So from my perspective, I'm starting to pick up some shorts. And you have to be alert to them in some cases because they're setting up as shortable gap downs, and I don't think that's a good sign. Solar industry is looking like garbage lately, and somebody's asking, how about 45s? 45 records, I remember those. I used to have a little record player, and when I was 11 or 12, I used to play The Who. That was one of my first 45s that I bought. Won't Get Fooled Again.
Yeah. Don't forget about 78s. Those really thick.
Yes, and there were 78s.
Flexibilities. they broke like plates.
Yeah, somebody said Dolby Labs. Uh-oh, I've triggered memories for everybody. Okay, but here you have a shortable gap down here. But notice how the stock was already looking weak. You reverse it to 20-day line. See, my first reference most of the time is a break through the 20-day moving average. And so you get it in here, you bounce off the 15-day line, but volume was weak 4 days ago. You reverse it to 20-day line. Could have gone short there, and then you get a gap down to lower lows, and now you're testing the lows of this range here. So a rally back up to the 50-day moving average, which is around this 67.43, might provide you with a short point. And I would say look for this sort of rally if the market starts to get in trouble, and it looks like we're going to start getting into a more of a concerted decline or consistent decline to the downside. So somebody's asking G Pro bottom fish. Man, now you really didn't. I don't think so. I would leave this alone. I don't really think there's anything here. I know people want to buy because it looks down and dirty, but there's no real bottom in here. Fitbit's another one. You know, if you get lucky and you buy, here's a pocket pivot here, I guess you could try and buy that, but it's not really going anywhere. So that makes me a little bit skeptical. We're coming down. What's our volume levels looking like right now? We're running slightly lighter on the NYSE, but 6.8% higher on the NASDAQ. So hard to say what's going on here. Kind of chopping around. Who knows? Maybe just step in and buy everything. So stocks that I've liked on the long side here. Salesforce, you pull into the, I mean, this one I thought was consistently viable as it pulled into the either the 10-day or the 20-day. You get a nice shakeout last week, and kaboom, it rallies to the upside. Now I'd be watching this pulling into the 10-day line. It's not quite there yet. Splunk is another one I think I've talked about, and it's just kind of tracking along this really tight area here along the 10-day and the 20-day. It's down a little bit, and maybe, you know, this is a spot to step in and pick up some shares using a very tight stop, either at the 20-day at 47.58 or the 10-day, which is 48.61, and only 4 cents above or below where it's trading right now. What other ones have I like? Oh, Mobilize, another one I think is interesting. You have a very low volume pullback into the 10-day line, 20-day line, and this stock has acted pretty reasonably well. But if you look at these on their weekly charts, again, to go long these, you kind of have to ignore them on their weekly charts because they look kind of sketchy. You know, this is coming up into this area of congestion in here, and you can see some stalling action on the weekly chart last week because the volume was up last week, and this week you're getting similar sort of movement. So it's, you know, it's a little sketchy. You can, I mean, even look at CRM, for example. That's almost V-shaped, and while it looks pretty good on the daily chart, the weekly chart looks a little sketchy because that's just way too steep. And you've been getting good volume figures though on the weekly chart, so it's not really clear, you know, what it is necessarily. But I think what you can do is trade them on the basis of the daily chart, keeping in mind, in the back of your mind, that the weekly charts have some flaws in them. And so my reference point for any of these would be the 20-day moving average. If I'm long any of these, I'd like to buy them as close to the 20-day as possible and use that as my stop, so that if they do fail, I'm gone, and I could flip to the short side in that event. So, you know, that's something to think about, and I think it's a sensible approach in this market, because the pullbacks, you know, a lot of times they're viable, but I still think you're getting to a point where you're a bit stretched on the upside, and so you definitely have to be more alert at this point, given the extension in most stocks. So I mean, you know, the airlines have been strong, okay, but Alki is I'm looking as a short right now. We'll see how this pans out. So far it's working, so that's good enough. And you look at Hawaiian Airlines, you get a nice pocket pivot 4 days ago, and it's hanging along the 10-day. So, you know, you could try and buy it here, but again, if you look at the weekly chart, it's fairly extended in here. And on the weekly chart, it's sort of running out of gas, and you can see some stalling action on the weekly chart. So if you step in and buy this here, you definitely want to be using the 10-day or the 20-day as your stop. Now, if you bought down here when it was starting to break out, you know, there were some pocket pivots, I believe, down here, then you're in a better position, and you can figure out where you might want to set your stop. But, you know, it's extended, and I would be wary of buying into extended names. So, you know, another one, let's see, Love. This one getting a little sloppy, but chopping back and forth. But again, here's what you're looking at on the weekly chart. It's very V-shaped, and so this could be a pod. I mean, this definitely has pod-like characteristics. This had pod-like characteristics, and when it reversed and failed, it was a short. Now here you're coming up again. Are you going to create a double pod here, and does this thing kind of just come apart? And I would be watching for that up here, because I think that's a possibility if the market starts to break down. So a lot of these, while they look good on the daily charts, and I'm happy to trade them on the long side, and trade is the operative word here. I'm not sitting there looking for big gains. I'll catch 2 or 3 points, 5, 6, 7, 8% if I can, and then bail. It's like the Ambarella today, you know, was up $1.80. You sell into that move. If you bought it, say, off the 20-day line. So let me see if I can, how can I make this look bigger? I can't really, can I? If you bought it, you know, here off the 10-day and you get this pop, you're buying it down at around, what's the low here, 43.88, and it pops to 46.44 today. So, you know, you're getting a 6, 7, 8% gain. I think in this market you sort of have to take that, you know. Somebody says or asks, if you use a 10 or 20 day as a stop for going long, what do you use 50-day for? Well, nothing, pretty much. It's not as tight unless a stock is very close to the 50-day. In that case, I would use the 50-day as an area of support. Now, what I'm talking about with the 20-day also is that I use it as reference for stocks that are breaking down either on a late-stage failed base or that are in a rally, like, say, Salesforce is. If you had a breakdown through the 20-day on volume, which actually would take you through the 200-day if you can see it, then I would consider that to be a sign of a breakdown, because that's usually your first sign, is a breakdown through the 20-day moving average. So you can also see in a situation like Workday, I mean, this stock, I traded this on the long side. Actually, this is when I first started trading it. I was trying to short out, and you guys have heard this story already, but I was trying to short it here at the 50-day line, and then I just flipped and went long and rode it up to the 200-day line. It ran into resistance once and then cleared it the second time on a pocket pivot, believe it or not, and now it's just holding tight up here. But if we look at the weekly chart, this is what it looks like. And that's not something on a weekly chart basis that I would really want to step into, and that's where a lot of these things are. So when I say that, I'm watching these and I'm playing them on the long side on the pullbacks and trading them actively. I'm at the same time I'm aware of this and the fact that they could break, and so I'm ready to do whatever the stock tells me to do. So take it from there. Triple D. Well, I noticed the 3D printers were all trying to, but this kind of extended. So, I mean, that's what it looks like off the lows. It's kind of extended. It's doubled off the lows, so I don't know. I don't know if I'd want to be buying it. I noticed Stratasys, SSYS is looking a little bit better, but, this is what you're kind of getting. It's this, what the Japanese call the frying pan with handle, which is the forerunner to the cup with handle. But when they used to trade, I guess they use their chart patterns to trade rice futures, and so a frying pan and handle is usually a bottoming formation, whereas O'Neill uses it as a breakout type formation, and you want to see a 30% or 35% uptrend before the formation forms or the pattern forms. Here you sort of got this frying pan and handle, I don't know, more of a cup with handle sort of bottom, and it's hanging along here, so you get a pocket pivot here. And if this one looks a little better to me just because it's taken some time to consolidate. And, if you think it's viable along the 200-day line, it certainly was yesterday. So it hits a 200-day line, you rally about $1 or so off the lows. So market's floundering around. I'm curious, we're down 145, 146. I'm curious to see, what were the lows, like minus 180 or 170, something like that, Dr. K?
Yeah.
So I'm curious.
And then we're bouncing.
Yeah, you're getting an
looks
intraday
like
bounce.
200-day or keep close to that juncture. Just getting some support here.
Yeah, you're getting the typical intraday bounce after, because everybody I think has been conditioned to buy the pullbacks, and that's what's been going on, because you just have a QE market, money sloshing around, buy the weakness, sell the strength, and do it all over again the next day, and over again. You'll become rich, I guess, but only if you're a high frequency trading program. Let's see. Somebody asks, on shorts, do you look to buy on strength versus buying on weakness when going long? Well, when I'm shorting. So I'm not really sure what that means, but I'm going to make some assumptions here in that when you're talking about something like this, if I'm shorting something and I think it should be running into resistance and I can feel that it's not, and I can feel a strong bid, sometimes in the face of that strength, I will turn around and go long. So in that case, it's not something I was looking at going long, but by being shorted, I can sense that there's a very strong bid in the stock and it doesn't want to go down. So my view is, why fight that? If I can feel it, and a lot of times, after shorting for as many years as I have, I can feel it, and I just flip the other way. And a lot of times these things will just keep rushing higher. Now with workday, I'm shorting at the 50-day, for example, and once it flips, gets through it, and I can feel things are getting strong, and I flip long, now the 50-day becomes my downside guide for a stop. And what I'm looking for is a rally to the 200-day line, which in this case I got almost perfectly. So it's almost too perfect, When things work out that well, it starts to make me nervous, but that worked out pretty well. But, that's just buying into strength is more, occurs when I'm short. And I would say I'm flipping into strength because I can feel how strong it is. And I do that more often these days. I'm thinking if I had understood that rule better in 2009 when I was short bank stocks in April of 2009 when they all started jacking to the upside, I would have probably made a lot of money because I would have flipped to the long side of all of them. And instead I stubbornly tried to hold short because I was basing it on certain fundamental flaws that the banks all had and also on the overall patterns. But I've learned since that you can start to get a sense of when the bid is so strong you have no choice but to just flip and go with the tide, essentially. So that's what I do these days, and that's one of the things that I've learned to do that has improved my performance on the short side by quite a bit. So, but like Dr. K coming up with better ways to handle the VIX model. We're doing this all the time. You have to continuously evolve. You can't become static and pretend that, oh, the market only works one way. You buy breakouts and you try to hold them until you have a 6-7% loss, which in this market just ensures that you're going to have a lot of 6 to 7% losses. You have to move with things and learn from your mistakes, and that's what we're always trying to do. I mean, that's what makes it so much fun. I've never had so much fun being a screw-up. Let's see. Any other wonderful, brilliant questions? We actually have a pretty good crowd here today, so I'm sure everybody's probably wondering just what's up with this market. I'm going to go over some other names. I mean, I've had success with Square. I mean, this is one of the few names you had a breakout on a couplet handle, and it's very V-shaped. So, this was I was a little skeptical of this, but bought it right around 1205. You had a nice move on a pocket pivot. Well, it wasn't even a pocket pivot. But this thing jacked hard up and then straight back down to the 10-day. So you can trade these. You go up 10% in one day, you sell it, you buy it back, it runs up. You sell it, you buy it back at the 10-day. And you may not sell it perfectly, but I think you can catch it again at the 10-day. Now you're kind of wedging back up. Volume is lighter today, so it looks a little bit sketchy to me. I wouldn't be buying it up here. I'd be looking for a pullback to the 20-day line. But there's a huge amount of short interest in this. I think about 10 million shares on a 32 million share float. It's about 30% of the float is short, and I'm wondering if that's what's driving this turkey higher. So someone's asking, Ed O'Neill, did you glean any value to up-down volume metric, especially for stocks that trade over a minute? Not really. I didn't pay attention to that. Bill used to look at the up versus down volume. But, somebody brought up a point, that's when I was having dinner with the guys, and I think we were questioning whether volume even matters anymore. And the idea that if 90% of the volume out there is these high-frequency trading funds or algos, how much of it is real accumulation and not just things getting batted around like cats playing with a ball of yarn? And that's a good question, because a lot of times you'll see movement, in other words, a heavy volume sell-off. Like, look at the Square. When it broke out and ran up, okay, the volume picks up. It's higher than the breakout, okay? Let's see if you can... Here, I'm going to use my pen because that gets me excited. But you can see the breakout here, okay? And the thing jacks, and it's a nice looking breakout, okay? But then it gets whacked 2 days later on heavy volume right here. And if you're looking at that, you're thinking to yourself, okay, it broke out. We know how breakouts work in this market, and the volume is very heavy. So somebody's selling into that breakout. And so you might get scared away. And that's the other thing about this market is that when they look really scary, that's about the point where you need to be buying them. And, that's an odd way to have to operate because it's sort of against all your normal psychology and what you know from volume selling and whatnot. A move like you saw in Max Linear. In the old days, if you saw a break like that, a gap down on that kind of volume, I mean, you were out the door so fast, you didn't stop to wait to see what happens. And, of course, what happens? It turns around and goes higher. And that is the sort of thing that makes this market very perplexing. And it's constantly changing. So as I was joking earlier, the only thing that changes is change, which is always changing. So that's how it's gotten. So it's one of those Zen koans where the only thing that never changes is change, but then the only thing that's always changing is change. Get it? That's deep. Think hard about that one. I suggest doing so after maybe 3 martinis. It'll help. Somebody says, but doesn't that type of volume movement become indicative of the manipulation from Wyckoff days? Yes, that's a good point. And that's why I think the market has become less O'Neillian and more Wyckoфfian, if that makes any sense. And so you have, because I think there's much more of a manipulative force in the markets with the QE, and Dr. K, feel free to chime in if you have anything to say about this. There's a much more manipulative force out there with all this QE and all these programs and the HFTs and whatnot, that it's more like the way things were, say, in the early 1900s. Now, I never traded those markets, and it would have been interesting to go back, or would be interesting to go back in a time machine and trade them to understand what kind of manipulation could take place. But I think in those days, because the markets were not that broad, you didn't have the public participating to the extent that they do now. I mean, you didn't have all these mutual funds and everybody and his brother with a 401k owning a mutual fund. I think it probably was subject to manipulation, and so if we'd been able to trade back then, we may find that this market is similar. So the early 2000s are like the early 1900s, maybe, but I don't know. But I think that's what Wyckoff was talking about. Oh, blah blah. Let's see. Tesla. Tesla's funny. I was tweeting the other day that this stock is, if you like to short this one, then you have to be a glutton for public punishment. So many people want to short this, but I've stayed away from this for two reasons. Number one, huge short interest. Number two, I can't borrow it. So that's, in a way, that's been a godsend because it's kept me from trying to short it, because it just goes higher. And you had two pocket pivots right at the 200-day line last week on Thursday and Friday, even though they stalled a bit. And this one, and even I think on Monday we had news that, or was it last week, that their Gigafactory, yeah, last week around in here, the Gigafactory, they're pushing out the date that it's going to be ready by 3 years, and that didn't even kill the stock. And then they come out with their sales numbers, and they fell a little bit short of expectations, but that didn't kill the stock. So I watch Tesla, and when I see news like that and it doesn't kill it, I just flip and go long the thing. And if I'm looking as a short, I just buy a couple thousand shares, and you make some lunch money, you know. And the thing's up $20 or went $20 higher, then well, I take that back. You got about 30-something bucks higher over the last 4, 5, 6 days. So if you're long a stock on that, it's a nice gift, and I probably would end up taking that gain. But it just shows how they're just destroying the shorts on this, and it doesn't make any sense because, but it doesn't have to. You know, in this market, nothing makes sense. The less sense it makes, the more sound the trade probably is. But in this case, I think you just have too many shorts in it, and there's no real news to kill it. You know, unless Citron Research comes out with a panning report on it and they slam it. So, can you describe how you can tell an undercut and rally versus a stock failing? Well, you can't. What I do when I see an undercut and rally, let's take a look at Love. Okay, here's a situation where, if you look at this, the stock pulled down and undercut this low. So if it's a stock that I've been interested in buying, okay, the pullback brings it into a position where I might look at buying. So what I'm watching here is a 620 chart. If the 620 chart on an intraday basis flips to a buy signal, then I might consider that a signal that it's turning. And that's usually the guide that I'll use. And that's pretty much why I started using the 620 chart on the short side, because I noticed that as stocks come down and they break areas of support, the 620 chart will get me out on an undercut if it's going to turn most of the time. So that's why I started using it, and that's how I can determine whether something's an undercut and rally or whether it's just going to fail altogether. So because you can't tell, but you do have to have some sort of mechanism, some sort of tool that's going to guide you and keep you from getting your head ripped off, because I've seen a lot of instances where a stock will undercut a low and then just jack to the upside, you know. And you saw that, say, in here with a lot of these. Let's look at, like, remember Palo Alto Networks, you know, where it was breaking. I'm trying to see, I don't know, maybe that wasn't the one, but there was, you know, there was a stock that was breaking to the downside, undercut a low, looked like garbage, and maybe it was Tesla down here, way down, way back here, you know, I forget. Here's there's a situation. Here's where it undercut, and then you can see that was the low, and it looked like it was breaking support, but it undercut, and then it turned and it rallied hard. And you had to be, if you're using the 620 chart, that could have saved you from getting caught in that, although it didn't really take off too much. But you'll see that a lot, and really the only way to be able to tell is by using a 620 chart to guide you and willing to be active, because if it fails again, you may want to come back and go short the stock again after covering. Now, I do that quite a bit on the short side. So what time frame do you use on the 620? It's a 5-minute, so it's a very simple chart. Okay, now, and it's a tool, okay, so you guys don't get hung up on it as a system, and it's very simple. You got a 6-period exponential and a 20-period exponential. 6 periods orange, 20 is blue. Why? Because I like those colors, and they correspond to my MACD, which is the same. 6, 20, and 9 and C are the settings on it. But it's basically when you get across, or I'm watching the MACD along with it, and I notice certain stocks seem to trade a certain way, and so I will use different clues from the chart to guide me. So if I see, for example, if I see a stock coming down hard, look at, you could have shorted Tesla this morning, you'd get a nice 10 points out of it so far. And you can see the 620 signal right here, and it occurred after the MACD cross. But notice also that as it's coming down, the MACD starts to stretch and get way down on the downside. And so that's when I would be looking at covering my short position as it gets down to the extreme lows on the MACD. And sure enough, you get a cross, and you rally back up to the 20-period line. Notice how that magically works as resistance. I think I originally started using this because my trader, our old trader Bill Griffith, had a lot of experience on institutional desks. He told me that one of the tricks that they would use is a 20-period line on the intraday chart. So I started messing around with stuff, and that's how I came up with the 620. And then I was testing it on trading Forex and whatnot. But so you can actually see how it rallies up. You could probably come in and go short again on the move up to the 20-period line. And then if it does cross, then you're just gone. You cover and you get out of the way. So that's what... Anyways, Dr. K, someone would like you to talk about you talk a lot about this rule about taking profits on the VIX, but you never really talk about the specifics of the rule. Do you have anything to offer in that regard?
Well, it's like it functions in a way like the fail-safes. It automatically adjusts to market conditions. So basically, we've had a number of these days where if you're trading the 2x UVXY, you're sitting at 15% or more in the money. And that 15% is not a magic number. It's just a number that says, look, this is a big percentage in a short amount of time, and we should think about taking at least some profits off the table. But what I did was I refined it to where it's all or nothing. So instead of being a bit fuzzy and vague and saying, oh, in the beginnings of the model when it was launched in beta on the site, some of you may remember I sent out some notations about, well, we're in the money by more than 15%. You might want to take some partial profits. And I know that some people did, but that also begged the question, how many people didn't? Because it was very easy to get into this greedy mindset about, wow, this is so much profit in such a short amount of time. Maybe there's more juice to it. Maybe it'll go to 25% or 30%. And in a couple of these cases, it peaked at 15 to 17% and then reversed back down. And then there were some cases, of course, where it went all the way up to, I think, almost 30%. So what I devised was call it an intelligent strategy, a self-learning strategy that conditions itself to the market environment right at that moment. So the next time we have a 15% gain or more in UVXY, obviously it's going to go on red alert mode on locking in those gains, but it's not going to just automatically take a 15% gain because again, the market, there's no such thing as a hard number that you could just say, oh, this rule applies once we have X percentage, then we automatically take the profits. That's not a very smart rule because market conditions change. And that said, that 15% is not firm either. I mean, we could get the rule could kick in and UVXY is only at 13% or something. So it's not hard and fast. But there are some, what I noticed, some fairly simple times where you get that 15% roughly, and then it just keeps going. And this is where the 620 rule comes in very nicely. I'm utilizing intraday concepts to exit the trade with the idea of maximizing the profits in that kind of situation. What also keeps it clean is that when the markets, we say that the markets take the stairs up, but these days the trapdoor down. So when that trapdoor opens, that 15% sometimes zooms. Sometimes the market goes well past 15%. Not necessarily on that day. Sometimes it's the next day, but nevertheless, you get a follow-on, and you can end up exiting the trade with a very handsome profit that exceeds 20%. And this is based on all the testing that I've done over the cycle. So it's nice that this character of taking the trapdoor down, or at least the elevator down, seems to hold true whether we're in this kind of QE environment or a non-QE environment, because as O'Neill always said, these charts are human nature on parade, and human nature really hasn't changed much at all in the last 100 years.
There's a pretty good question just popped up. I've noticed sometimes the market tops when you see the last junk group explode. Could yesterday's biotech fury be a sign the last group of idiots bought into this rally? You know, I was thinking that exact thing yesterday. It's like, okay, now the biotechs are moving, so now they've got everybody in this market, and now it's going to roll over. It's a possibility, but I mean, it's speculation. I think you just go with the concrete action in what you're seeing in the market. So, hey, Dr. K, what is the fail-safe? Someone's asking about, can you elaborate on the fail-safe for the VIX model? The former email was unclear to me. I don't know if that means you can make it any clearer, but do you have anything to offer on that, on the fail-safe for the UVXY, or the VIX model, rather?
What was it? I'm not sure what was unclear. I mean, obviously the fail-safe, the former email, I'm not sure which email he's referring to, but as everyone knows, the fail-safe adjusts to market environment. So, like I was saying, most people would notice that the fail-safe is generally contained to within 1.5% if you're trading a 1x ETF. And as it goes higher, then the fail-safe adjusts where it becomes break-even, which is nice, roughly break-even. Because then that's a luxury, because then it's all gravy. In other words, the worst that can happen, unless, of course, we have a gap down or something overnight, but in general, the worst that's going to happen is that you break even on the trade. And in most cases, if you have enough of a gain, like we have in our current sell signal, the sell signal, the odds are that the sell signal will be closed out at a profit of some sort. Some people might have already started taking partial profits, especially when this particular signal cleared 20% or even 15%. There's no automatic profit-taking rule, though, on the sell side, because the sell side it relies on uptrends, and these uptrends can persist. And again, testing has shown that some of these gains can be quite substantial, just by the sell signal, by the model sitting in the sell signal for many weeks. And by substantial, I mean, we've had some signals that exceed 50%. For just one signal, and that would take place, say, over a period of 3 months with the models sitting on the signal. So I'm a bit loath to create profit-taking rules on sell signals, just because there are chances that you could miss those outliers. The outliers are extremely profitable, but again, over a period of generally several weeks or more. As far as can you be more specific? Have I cleared out any of the fuzziness about the fail-safes, or was there something more specific you wanted to know? He or she.
Well, they didn't really specify, but I'm just going to answer another question. Somebody's asking about AYI. Well, I don't know. What, you can't figure out a viable gap up? Is that what you're saying? You have a viable gap up with a low of 139.08. So if you buy it, if you think it's going to be a huge leader, and to me, I think this is failure prone. You got a kind of a pod-like. How deep is this, Dr. K? This is, you go from say 242 down to 168. What is that? What's the percentage on that? Can you run that through your head real quick?
Something roughly 30%.
Yeah, I mean, you get this deep V-shaped cup thing, okay, and then you get a handle that's sort of wedging along the lows, and then you break out on a gap up. I mean, if you're going to play this, then you would buy it, using the low of the day yesterday as your stop. Otherwise, I would stay away from it. I don't think this is going to result in some massive move. I mean, this stock's had a long move, and it seems to me more late stage than anything. Let's shrink it. There you go. So that's what it's looking at. It's very V-shaped in here. It looks kind of funky to me. I'm, if you're going to buy it, you'd want to buy it as close to 240 as you can. But I'm skeptical. This to me looks like potential late-stage failure. I noticed yesterday you had gap-up breakouts in GPN, which is actually working. But again, look at this formation. It's kind of a big, sloppy pattern. And one of the points I make in the new short-selling book is that topping patterns, or the the base from which a stock generally will fail is one that looks like it's similar to looking at a clown's shoes. You know how the shoes of a clown are these massive, goofy-looking, floppy, weird things that are totally out of proportion to the clown himself, unless he has a huge nose the size of a basketball and some other weird stuff on. But in any case, you can see how this sort of becomes clown-like. I mean, it's this big, deep cup formation. Looks to me like, it could be about 30% deep, but it's coming out, and so are you going to buy that? I don't know. If you bought it yesterday earlier, then you're making money, but I'd be looking at trading something like that. And I think there was another one. Booz is happening. So here's a gap up breakout. But again, look at this. STZ has had a long move higher. You had a Bible gap up type of breakout, but notice the breakdowns here on the left side. To me, it's kind of iffy, So I don't know. If you want to buy any of these Bible gap ups, at least buy them in a spot where you keep your risk to a minimum, and that means buying them as close to the intraday low as possible and blowing out of them if they don't work. So, is your new short selling book available now? Yeah, you can go on Amazon. It's there. It's only $30. You can buy that book for $30, or you can be a fool and pay $699 for IBDs. What I think is a pretty weak home study course on short selling, but they're just trying to gouge you as far as I'm concerned. I think the new book, and if you buy the first book that I wrote for Bill O'Neill back in 2004, How to Make Money Selling Stocks Short, you read that first, and then you read the new book, Short Selling with the O'Neill Disciples. You'll be pretty well grounded in all the particulars about short selling. So, my suggestion is for somebody who's new to it, start small, start slow. Because you can lose a lot of money if you screwed up, and trust me, I know. And one of my big efforts over the years, particularly since 2009, has been in trying to figure out how to avoid getting my head ripped off. And I've come up with a lot of practical methods to do this, which is all in the new book, and so you can read one and then the other. That's your assignment for this weekend. Anyways, that's all we've got for now, you guys. It's time to go. It's 9:03 my time, and I want to get back to this market because I think we're going to be down, let's see, I think 400 points on the Dow by the close. So is that wishful thinking? Maybe so. But like I said, I think you could come down more than we have so far, and it could just be a pullback, or it could be the start of something worse. I don't know. Anyways, you got anything else to add, Dr. K?
No, I'm good over here.
Okay, so on that note, we will end today's webinar. Thanks for showing up again, as always, you guys, and we'll catch you next week. Have a great weekend. Take care.
So long, everyone.